Welcome everybody to Sustainable Change Alliance. This is our first meeting of the year, and it's a pleasure to be with you. Its topic today is 2021, Impact is Everywhere. We're going to be looking at opportunities for impact, hearing from directly from active impact investors, as well as advisors working in the category. So very excited to be bringing that to you today. Before we got started with our topic, I wanted to introduce myself. I'm Matthew Stotts. I'm a member of the Sustainable Change Alliance Foundation Board, also a member of the SCA Inc. Investment Committee, and an active impact investor locally here in Santa Barbara, as well as I have the good fortune of being able to work with entrepreneurs in several continents and in different areas of the world working on impact. And really excited to bring to you just a quick update of where we've been, because I think it provides a great foundation for where we will be going. So just a quick note to everybody that the event is recorded, and you'll be able to share copies of this with others who weren't able to make it to the event today. And we will have a chat room where you can ask questions, and we'll be able to make sure we get those to our presenters today. And we'll also be having a brief event afterward where we'll have a little social time to interact. So just briefly, the Sustainable Change Alliance is about building community through impact investing. And it's really an opportunity for us to connect both here virtually as we deal with the fallout from the pandemic, and with the purpose of connecting our community. So all of the diverse and different organizations, both for-profit and nonprofit, community and individual, to coming together to find new solutions for some of our more intractable social and environmental problems that affect us here locally in Santa Barbara. With that in mind, I wanted to give you just a quick overview of some of the remarkable things that we've been able to do as a community together here at SCA. We've talked about healthcare and the COVID response, hearing from both our community members at Cottage Hospital, as well as entrepreneurs and medical professionals. We brought the community together to work on agriculture and food resiliency, tackled the issue of homelessness and looking for equitable solutions to help our homeless community members, looked deeply into energy investment from solar to hydrogen and everything in between, delved into environmental issues with strong support from our folks at UCSB and the Bren School, as well as local entrepreneurs and members of the business community from Patagonia. Looked very hard at the issues impacting our local businesses due to COVID. We see this unfortunate fellow getting his hair cut out on the street. And we looked at a number of different ways to help those smaller local businesses dealing with the short-term impacts here that might have a long-term effect on our community. And ultimately looked at a number of different young companies coming up, and had local investors from Entrada, individual investors as well, and many different startups, many coming out of the UCSB ecosystem. To that end, our impact investing footprint with companies that have come through the Sustainable Change Alliance process for presenting and gathering introductions and collaborating with our members have raised in excess of $4 million in 2020. So a great track record of engaging and investing in impact. So I wanted to thank all of our sponsors, founding sponsors, Maps.com, Argyle Partners, UBS, and Impact Family Office, our platinum sponsor, Nixon Peabody, silver sponsor, Brashears, and all of you for being members and inviting your friends in the community to join us in 2021 as new members. So thank you for that. And as we start to kick off our topic today, so Sustainable Change Alliance is looking at impact everywhere we can. And the opportunity in the discussion today is to see how we can get started, how those who've come before us or have specific strategies of impact have done it, and what they may be looking for next. And so to kick that off, I wanted to introduce Tom Bird, who's going to be our first speaker. So let me just toggle over here just a little. So Tom has been an entrepreneur and investor in early stage companies and impact firms since 1988. He's a mentor and entrepreneur in residence at the Harvard Innovation Lab, a mentor with the Young Transatlantic Innovation Leaders Initiative, a program of the U.S. Department of State, and a founder and CEO in the Silicon Valley information management firm Farm Inc. So he's a trustee of the American University of Bulgaria, a director of B-Lab, managing director of Sonnen Capital, and many other accomplishments in impact. So I'm really excited to have Tom here as a member of our community and an impact investor to share a bit about how he's views impact, some of the investments he's made, and he'll have time to take a few questions from us and everybody on the line today. Tom.
Well, thank you. Great introductions. Many of those things you mentioned have happened over the course of many years. They're not all going on still at the moment. Loved hearing about the SCA a little bit and some of the really interesting work you've been doing so far. So that was quite interesting for me to hear that in the beginning. I see my longtime business partner, Ken Saxon's on the line here as well. And some of you would know Ken, I'm sure. And Jim Villanueva would be another guy. We were all classmates at Stanford back in business school in the Stone Age, 1988. So a long time ago, and have been, dear friends since. And the way that I really got going in this was Ken and I ran a company together after business school for about 10 years. And as we got close to the end of that journey, that entrepreneurial journey, we talked to each other about the philanthropic impulse that we had, but we were pretty tangled up trying to get to the finish line on closing a transaction. So we didn't have a lot of time to be thinking about where we might want to put that philanthropic impulse to work. So the donor advised fund, I'm not going to go into that too much. You can, for those of you who don't know about it, would be useful to learn about donor advised funds in general. Great way to give money away and make one key decision, which is how much do you want to give away? And so we were able to make that decision and then take a deep breath and say, well, now we have some time to think about where we might give it away. So we separated the how and the where into two parts. So that both Ken and I set up donor advised funds. I had moved to Concord, Massachusetts by then. So I got involved with the Boston Foundation. Ken moved down to Santa Barbara and got involved with the Santa Barbara Foundation here. And off we went on our expressing our philanthropic impulses in different ways, but always collaborating together as partners in many different ways. So what I found in the early 2000s, working with the Boston Foundation, was that they were unresponsive to the idea that the corpus of the money that had been given away would be well used if it was addressing social or environmental kinds of issues. So that time lag that I mentioned before, that time, once it's in the holding tank, if you will, at the donor advised fund, I thought it made sense for that money to be working for impact as well during that time period. And they didn't agree with me on that, but it took several years before I was able to find an innovative firm called Impact Assets that agreed exactly with that assessment, saying that if you set up a donor advised fund, yet you haven't given money away yet at the back end of it, what might be done with it during that holding period? And how can you use the corpus of the money in the donor advised fund? So they were very innovative with their openness to taking that corpus and having it advised by the advisor into direct investments or fund investments, or of course it could be given away at any time to 501c3s in the US. So it was great to develop a relationship with impact assets as I was being sort of experimental at that time. It's about 10 years ago. So the next step, and I have two ideas I want to share with you. And here's the first one is that, so as I was doing my experimenting with impact assets out of this donor advised fund, a couple of other graduate school of business friends from Stanford approached me and said, what you're doing sounds really interesting. We're very busy. We got full-time gigs. We're not going to do all the work that you're doing, but we would like to tag along with you on this. Like to piggyback on the work that you're doing. And what we agreed was we could set up a separate donor advised fund. We could all chip into it together collaboratively. And then I would remain the advisor advising what impact investments we might make out of the corpus. So the first idea is a collaborative donor advised fund. It's pretty simple. And if there's a way to set that up where you are in cahoots with a group that you know, and there's clear lines of decision making, that can be a really interesting, rewarding, fun kind of a way to get involved in impact investing. So for me, I was the advisor, but some of my friends were able to look in over my shoulder mostly and really get started. And that kind of fits with what I just heard about SCA, that this notion of building community through impact investing as one of your core ideas. That collaborative donor advised fund idea fits with that. So the second idea is that I want to share is scroll forward several years, having made several different impact investments during about a 7-year period. I began to think about what am I going to do with this? Now we have about $3 million that we've all put in together, and we've been putting that out with the hopes of having it come back to be recycled. But what's the next step? Should we try to turn the 3 million into some much larger number by adding other collaborators with us in this donor advised fund? Should we hire some young people to work on it with me? So there were some strategic options, but the one that really struck me was what I think is an innovation that I'm trying out in the process of trying out right now is I wanted to use the metaphor of a greenhouse. So if you think of the original donor advised fund as a greenhouse, what I'm doing now is taking cuttings from the greenhouse and helping to set up new donor advised funds with other collaborators who then put in their own capital. They might add other people in on their own thing. And it really is an opportunity for me to share some of the investments that are already in my little ecosystem, put it into a new place so that the new leaders of the donor advised funds are able to take their ideas, but not from a standing start, they're get on a moving train. So there's some momentum that they have. There's some real investments to look at and work with and deal with. So this notion of the greenhouse cuttings I've been executing over the last 3 years. There's now 8 donor advised funds that are part of this little network. And there's about $12 million at work in this network. And what's really been fun for me is this notion of cutting off a piece of the actual investments, sharing the network, sharing the playbook that I've used in the past. So that's really the gist of what I wanted to share with you today. To mention also that one of the collaborators on this is Kiah. So you all know Kiah, and so he's a good one to talk to about this. One of the 8 donor advised funds is with Impact Family Office. So that's an opportunity to think about collaboration in other ways as well. So
Tom,
that's a little bit of the story that's a structural, those are structural ideas that I've shared with you. Happy to take some questions about other things if you like, but there you have it.
Thank you, Tom. Something on that structure I think is so unique. So just so we make sure we understand that fully, you took your original fund that you'd set aside and actually put seed money into these 8 additional funds. Is that correct? With different people advising or being involved in those 8 different funds?
Slightly different than that.
Okay.
Actually took shares of stock in the companies that we'd already invested in
Interesting.
and moved over the shares. So some put a little bit of cash in too, because to cover fees, responding to the needs of impact assets. But primarily, it was privately held shares in impact-oriented companies that then could be the start of an impact portfolio for others.
Wow, that's remarkable. Maybe talk a little bit about those companies and some of the ones that for you have been really rewarding to be involved with, and maybe those that were also financially rewarding back to the fund itself.
So, well, here's an example that some of you might have heard about that serves as a good one. I think typically it's called D-Light Design. So many years ago, it'd be about 2007, I would say, I met a couple of Stanford Business School students. They were in the second year and they were starting to think about off-grid energy, particularly in India. And they had had some experience that kerosene was just not a way to light huts and different places that were off the grid. And so they developed a solar lamp that they were able to sell for a very low price point, and have built a company that's about $100 million in revenue now. It's 13 years later, but $100 million company that is serving all kinds of spots in Africa and India. So as any investing story goes, there is opportunities, there can be opportunities to get out and go through an exit situation as different investors come in. So I was in at the very beginning on that one. So there's a seed round, there's a Series A, there's a Series B. There were opportunities to get out, but the prospects for going forward were so good that I passed on those opportunities. So there's this tension, if you will, with wanting to get capital back into the fund to recycle it, but also wanting to roll along forward with winners. So that would be an example of one that I've stuck with over a very long period of time. Another example that, any direct impact investment is going to be a risky proposition. One of the companies I got involved with right at the beginning was called Think Impact, and it was about experiential education in the developing world. And over the years, I'm going to say 6 years about, Think Impact was able to combine with a couple of other different experiential education in the developing world sorts of companies. And they had a $6 million business about break even going into the COVID situation. And tragically, this is one of those ones that college students and grad students aren't traveling to Africa, let's say, weren't doing that this past summer. And so really hit the wall on what was happening with the Think Impact group of companies. And we thought we could take the hit in 1 year, but not a 2-year hit. So it's now been closed down. So we go from 6 million in break even to close down in quick fashion. So part of the nature of impact investing is there's clearly risk and return, and you're not always going to win, and you have to be comfortable with that. Part of the reason I say that is that for me, the lesson is that the donor advised fund model is a great way to get a taste of that and to really experience that with capital that you've given away into the donor advised fund complex.
Yeah, that's really I think a key advantage to making impacts through a DAFT is that opportunity to say, look, this is already going to be outside of my wealth preservation strategy. This is part of my impact or charitable strategy, and what more can I make of it? I think that's really compelling. Sometimes that impact only lasts a few years, and the company doesn't sustain. But if we think of some of maybe those charitable checks we've written, those may have been even far shorter term. So Really interesting to hear that story, Tom. I did want to ask a few questions from the group. Firstly, do you think differently about your impact investments and inside the DAF versus taxable funds and other investments, or are you looking for impact across the board? How do you kind of think through all of the different investing that you do?
So that's a big question, but part of the deal that I made with my collaborators was to say, I'm going to choose things within the DAF that I believe in enough to invest from in other ways. So I'm a co-investor in almost every one of the companies that we do out of the DAF. I co-invest personally. So both D-Light and thinking back those two stories that I mentioned, I put real dollars of my own in that as well. So that's part of the concept of saying to my collaborators, I'm really in on this. This isn't an experimental thing for me. This is a well-reasoned analysis that I'm doing that holds up under a variety of structures. Oh, we lost Matthew. You've gone on mute.
I'm back. So, Tom, I know your time is short. Maybe one more question here. Here's a question from Laura. She'd love to do a DAF focus on oceans, where she has some expertise, and she's wanted to be able to follow up with you with some specific questions on specific types of DAFs. But I thought maybe more generally you could talk about how are these 8 funds different? So Laura Francis, a member here at Sustainable Change, focused on oceans. Are some of these other DAFs that you're working with focused in different areas, and how does that work?
Yeah, so be happy to talk to Laura about the oceans concept offline if she'd like. And for me, the starting of the original fund, the thesis was, I care about all these themes, oceans, sustainable agriculture, off-grid energy. I care about all that. And I know that I'm never going to be an expert in any of that. But I do have a point of view about entrepreneurs. So for me, the guiding principle was as an entrepreneur picker, trying to select companies that could tell a compelling impact story and had entrepreneurs that I wanted to get into business with. So as I think about the greenhouse cutting strategy, that's can be transferred quite easily. And each new advisor in the new donor advised fund gets to pick their theme and express their philanthropic impulses and impact impulses through their own donor advised fund. I'm just trying to catalyze the way that it would get going. One short example of that is one of the more recent ones is with MIT. There's a group called MIT Solve. And MIT Solve has a wonderful program of supporting, mostly with intellectual capital, entrepreneurs that come out of a part of the MIT group. And they decided they wanted to get involved in actually supporting with financial capital some of those entrepreneurs. So in that case, what I said is I had backed, there were 4 MIT graduate entrepreneurs that were in the portfolio. I said, why don't we move those over into this MIT Solve, what we're now calling the Forward Fund. And that will hopefully catalyze donation on top of it that then can be used to support additional MIT solvers, as they're called, the folks that are the startup entrepreneurs. So that was an example where we were able to move over, but then this MIT Solver Forward Fund is going to really focus on people in their community.
That's an incredible impact, and I think just seeing how you started to work with an organization like MIT is inspiring too. I know we have some really impactful entrepreneurs coming out of the entrepreneurial programs up at UCSB, and something like that, I'm sure they'll be looking at with a lot of interest, hoping that we can get our act together and do something just as impactful as that. Tom, I wanted to thank you. I know you had a tight time frame here, so making time for us and being able to share just how you worked through your impact investing strategy. I hope you'll come back and join us at future Sustainable Change Alliance events. And I know that folks who have offline questions, we'll funnel those back to you so you can engage with people at your available time. Okay.
Well, thank you for having me. Really appreciate it. And I
Awesome.
look forward to connecting again.
Wonderful. Thank you, Tom.
Thanks, Tom.
If I were really good here with my Zoom skills, there I go. I got my little hand clapping up there on up on the screen. So thanks, Tom, for that. This question of impact, we had so many great ones come in while Tom was talking more broadly. And so for that, I wanted to bring in Kiah from Impact Family Office. So Kiah, I know you've been involved with Sustainable Change Alliance from the get-go, and you have a really interesting way to help different folks in the community. So I was hoping maybe you could just start by introducing yourself and telling us about Impact Family Office.
Sure. Thank you. And I'll say I've had an amazing time over the last couple of years learning from Tom's experience with the donor advised fund model that he's created. And that's actually been able to filter into some other work that I've done with other clients. I started Impact Family Office a number of years ago to work as a impact-focused, collaborative, multifamily office with no assets under management. And to unpack that, we're not the investment advisor. We work with clients, investment advisors, and we look at clients' lives and help align their values across them. I serve as a guide, an advisor, a trustee in their lives. And I've been able to work with clients on one end of the spectrum that give a lot of money and make a lot of money and don't realize or understand all of the different vehicles in between. They may look at impact as a category, not as an overlay that can be applied across all of their assets, giving, spending, and investment. And, like I just mentioned with Tom, when people are thinking about how they give their money, there's many ways to do it. And the donor advised fund model has been a really awesome way to identify areas of people's lives where they have charitable donations to make and are able to also look at that as an investment piece of their portfolio as well. So one thing that, Tom was able to talk about was this structure of working through a large organization like Impact Assets, which in its function is a foundation that provides donor advised funds, and at a certain size allows an independent advisor to recommend investments. Just as you would recommend a donation or a grant at a donor advised fund, Impact Assets, and there are a number of foundations around the country that do this, allow you to recommend an investment. So it still goes through their own committees vetting of is this an actual enterprise, and they, Impact Assets in particular, has kind of an impact thesis that they want to see in any of those investments. And so to step back and talk a little bit about maybe the personal application of impact in someone's life as well. It's there's a strong, structural component that we just heard about, and yet there's a lot of ways to think about impact in your personal life. And I want to touch on that a little bit because that can be really tricky. I'm taking my company right now through the B Corp certification process. So we're in the application process. Hopefully we'll be a certified B Corp in the next few months. One of the fantastic things about that is right now the wait time is so long because so many companies are applying for this certification. It's actually really encouraging. But in that process, some of the things that I've thought about as we think about this in our own lives is, how do we align our values with our money? And the question came up for me last year when I was thinking about where do I bank personally and with my company? And there are B Corp banks, some that are owned by foundations, others that have their own impact thesis. And I was looking at, how do I transition more and more of my own company operations into this space? And I ran into issues with, hey, they don't have the business products. that I need for my company. And so, you know, there's this tension between what can I do now with what's available, because this is an industry that's growing and evolving, and what are those trade-offs? So I had I opened an IRA at a B Corp bank, and they had a proprietary, you know, investment fund so that all of your IRA dollars could be in this impact fund. I had hoped that I would transition more of our business, you know, accounts and stuff over there, and really ran into an issue of they just didn't have the products that we needed for us. And I ended up moving my IRA out of there, and then had to figure out, well, now what do I do with the dollars that are in it when I had wanted it invested in this way? And so what I personally did was then looked at what are the available publicly traded ESG funds, and can I make a portfolio allocation by selecting a few with an appropriate allocation to do that? So that was like a real practical, you know, hurdle that I ran into, and then how I overcame it. And there's other ways to do that, but that's a big thing, to look at the custodians that even allow you to invest in the things that might align with your values.
Yeah.
Another quick one is, you know, I drive a plug-in hybrid. You know, that's great. I feel good about not buying as much gas. But when I plug it in at night to charge, what's on the other end of my cable that's running the electricity in there to provide that same energy? Do I really have any net positive externalities there? So those are some of the things you have to think out at the real granular level that might be applicable to everyone here, you know?
Kiah, I think it'd be interesting to know how you help the families that you do work with kind of wrestle with that that question. And is that, you know, from the trust aspect, and I mean, it's challenging enough as an individual to say, I'm going to try and make impactful choices, and I want to direct as much of my investing towards being impactful. How do you kind of approach that with clients?
Yeah, one of the first things I like to say is, you know, when we look at your life, are your investments creating the problems your philanthropy is trying to solve?
That's
and
a
just
great
thinking through that.
Say that one more time. That's such a great question.
Are your investments creating the problems your philanthropy is trying to solve? You know, are the things that you're investing in creating the issues that you're giving money to try and solve on the other side? And then it's a personal question of, is the return that I'm getting here overriding my values if I look at it from a philanthropic side? And are those in alignment? So we can think about your investments, the money that those output, your spending, and then a piece of that you might dedicate to philanthropy. And are all those things aligned? So that's a very early conversation that I have with clients that have an interest in going, I'd like my values aligned here. And one quick example, a couple of years ago, a foundation asked me to come in and kind of help them think through some things. And one of them was looking at their investment portfolio, and very quickly realized they own certain stocks that are in contradiction to their mission as a foundation. And that just prompted the necessity of an intentional conversation at the board level of, do we make a change here? Does the custodian even give us what we want in terms of alignment? And now that we know these things, we got to do something. We either have to choose to be passive about it or active about it. So those are some of the conversations that come up, particularly early on with clients that I work with.
Well, I think it is such a quandary, and I'm just thinking about my index funds, and you know, I have a pretty significant allocation to the Just ETF, which is a selection of large caps, and it's performed well. But then I have the broad market, and that's in my equities portfolio. And there are probably some companies in there that are contributing to my personal upside that I don't probably align with. And you know, taking a closer look is probably something we should all do. I wanted to bring in Stephen MacIntosh of Argyle Capital, specifically because you deal with that question around public equities, and remind him that he's muted now and needs to unmute himself so I can ask him. Tell me just a little bit about, you know, your personal approach, how you've personally taken on impact investing, and then how it informs your relationship with the folks that you work with.
Yeah, thanks, Matthew. Just as a little side note or a starting point is the amount of money that's out there in the investment space in the United States, or the money that's professionally managed by advisors, is just over $51 trillion. There's a group out of San Francisco that does a report every 2 years, and they just reported that the number or the amount of money invested or managed by professionals that has some sort of ESG screening associated with it as of the beginning of 2020 was $17.1 trillion. That's an increase of 42% from 2 years prior, 2018. So the bottom line is that it's accelerating tremendously. There's a third of our professionally managed money in this country has some sort of ESG consideration associated with it, which is just massive. And more advisors are being asked to actually build portfolios for their clients that include sustainable and or potentially impactful companies in them. I work for a boutique firm. We're just over $100 million. We're actually quite small. If you're in the advice space, you know that that's not a huge number. We keep our firm small on purpose so we can help our clients with a real high touch, personalized service level. But I joined Argyle in that the partners there give me a lot of latitude and a lot of support to manage my clients' portfolios with an ESG lens and with an impact orientation, and do it in a way that's righteous and real and substantive and not involving greenwashing. So that's one of my I think most proudest achievements so far professionally, is to be able to establish myself as an advisor and be able to develop portfolios in the publicly traded capital markets as well as private placements for my clients, that their portfolios are aligned with their values. They're not trying to solve climate change or hoping to contribute to the solutions or mitigations of climate change with a massive position in ExxonMobil or Chevron Texaco, or any of those big oil players. But how do you really achieve impact with publicly traded securities? I mean, you're just buying a share from someone that wants to sell it, right? You're not in that space. You're not plowing money into a company that's building solar panels. You're buying that share, that equity from another shareholder. And that's not really impacting that company. It's not promoting an impactful result. What it really is doing is like what Kiah said. It's having a portfolio that's aligned with your values, with who you are, is what people with publicly traded securities in their portfolios are trying to do. They're voting against something like ExxonMobil by selling it. They're voting for something like Plug Power, which is an amazing company that's just on fire lately, which is putting in hydrogen and zero emissions forklifts throughout all the Walmart and Amazon distribution centers throughout the country. So really on the public capital side, you're really just encouraging companies to be better corporate citizens with how you build your portfolio. But it's more than anything just aligning what you are, what you believe in, what's really important to you. I've had questions over the years about the return and the perceived weaker returns for portfolios in the ESG space. Like they just can't keep up with a fully diversified non-ESG screened portfolio. Well, that's actually not the case anymore. That was an issue 20 years ago, 15 years ago, where if somebody was trying to focus on a climate change angle in their portfolios, or it's one of the things they really believe strongly in, and they couldn't own any of the big energy companies in their portfolios, well, they were missing out on that vertical or that sector. And there were times when those ESG portfolios might have been underperforming a non-ESG portfolio. What's really happening now is that ESG portfolios are outperforming non-ESG portfolios. And a lot of that has to do with demand because of, as you saw, the trend in assets just ballooning to 17 trillion now out of 51. The growth is just, it's hard to imagine that there aren't people out there that are investing with ESG. But it's the growth of ESG and the fact that it's essentially a risk mitigation approach now to portfolio management. What you're buying when you have a company that's a good corporate citizen or is sourcing their feedstocks from a sustainably harvested lumber or sustainable feedstock or supplier somewhere, those companies are going to do better long-term and have less of an issue with running out of a product or constraints on their supply chain if it's sustainably harvested or sustainably provided. Also, in the ESG space is women on boards of directors or women in positions of leadership. That is now a proven fact that companies do better. The bottom line, they are more profitable when they have women sitting around the table making decisions. My wife is way smarter than I am. Her mind thinks circularly, and I'm way more linear and engineer-like and much more male. That's just the way it is. But that's a component of ESG. It's good governance. It's including a diverse set of leaders around the table. So returns on ESG investments now are actually outpacing and outperforming the non-ESG positions out there. And then to wrap up my preliminary comments, Matthew, how do we get it done? Well, we essentially find out what my clients' values are, or what our clients' values are, and we start building a portfolio from there. I never tell my clients they need to focus on climate change. That's a huge issue for me. Most of my clients do that, but not everyone. And I then will start building a portfolio again with publicly traded and private placements now. A lot of acceleration in that space for me with solar investments, conservation bonds, and that sort of thing. And it can include publicly traded stocks, bonds, mutual funds, green bonds, and private placements. You really don't get into the impact space until you're buying into private companies, I believe. That's when you're actually plowing into a new visionary or a new entrepreneur that's going to change the world.
Yeah, so you said, Stephen, that buying or selling in the open established market of public equities is a little more like voting, and kind of essentially cheerleading a particular company on by holding their stock and giving them the signal that you value them, and maybe your anti-portfolio in impact may try to remove all vices, so you don't own KFC or I guess Altria would be the new name of a former cigarette company or something like that. But interesting to your point that it's the newer companies or the helping companies actually get started that you feel is true impact. Are there any other asset classes or vehicles or we've talked about DAFs as a way to set aside money in a tax deductible kind of charitable fashion, untaxed, but then those are funds that are locked up that you can never access again, as they're treated pretty much like a charitable gift that you just happen to direct over a long period of time. And then we talked obviously about public equities. You mentioned the whole string of there. Are there new things? Are there other ways to begin for folks to begin their impact journey by directing their investments in different places, or trying, moving their money in ways that maybe we haven't heard of?
Well, I think one really important consideration, it was mentioned very quickly by Kiah, is where you custody your assets. I mean, if you are on Fidelity, or you are self-directed on Schwab, or you work on any number of those online sites, or you have an advisor who custodies at a particular place, your vertical or your interest might not be available. The instruments that you own, like Kiah owned a private placement on one site that he wasn't able to buy any longer, or it wasn't available, so he had to jump. So that's one of the first considerations, is where you custody, if they actually will allow you to have private placements. And unfortunately for them, but great for Argyle Capital and other RIAs like ours, we're extremely flexible, and we can bring private placements and private investments that are impactful into our clients' portfolios. So it's the custody and the RIA space. Those are kind of the two starting points, I think, for a lot of people that want to start really getting into impact, and working with advisors that know this stuff, finding someone like Kiah who really gets it, who understands where the opportunities are to start living and investing along or aligned with your values. There's one tool, Matthew, I'll just say this quickly. One of our members is building a charitable trust vehicle currently, and it sounds a lot like Tom's, but it's a charitable trust that's going to receive assets from DAFs and other places, and they're going to invest in different verticals. And as that gets closer, I think it'll be really interesting to bring him on our platform and have him introduce that to our members.
I think I'll add to that. In addition to everything you're saying, Stephen, as you get into more of the estate planning side, there are questions to ask your attorneys as well about what you can do in that space. There are vehicles where you can get, what you might call a return, money back from like a CRUT model. There's a NIM CRUT, net income makeup charitable remainder trust, that can allow you to have illiquid assets and carry over the annual distribution. So you can actually hold illiquid investments that might be more capable for private placements, that aren't going to have a return or liquidity capability in early years, that then can come out later. So I think there's, if anything, I would impress upon, everyone here to have the conversations about your impact interest with both your investment advisors, like Stephen, but also with your attorneys and your other, the other professionals in your world, to see where else you can apply that. Otherwise you can end up with misalignment. And in your estate planning, is the trustee, is the structure you've created going to be in contrast to your beneficiaries' own values? And think about how you create that alignment long-term as well for you.
You bring up an interesting issue there, which is ultimately, many folks' investment strategies broadly is wealth preservation, and it's if we're talking about a DAF, that is a specific structure for they're setting aside a one-time lump sum, or or maybe getting some tax advantages for capital that you may want to direct later, but you can really receive no income from that. So maybe we could get a better understanding of how do you approach impact if your primary objective is wealth preservation, ultimately with some form of active return. So you've got a little bit of cash flow.
Well, I think the opportunities to preserve your wealth are actually greater in the public capital markets now if you employ ESG investment tactics and strategies. The outperformance of ESG funds and ESG proven good corporate citizens the proof is in that pudding now, and that's where a lot of investors are going and staying with a good chunk of their portfolio in the public capital markets that aren't quite as volatile or quite as risky as private placements, where you might win on one and lose on 9. You know.
So Stephen, is that a basket of ETFs and stocks that you are screened for impact, but then also have a dividend or some other potential to make return?
Yes, no, and yes. It's stocks, it's bonds, and it's thematic mutual funds that align, that are very actively managed, that have tremendous track records. ETFs typically are like index investing, as you probably know, Matthew. They're super cheap. Sometimes you get what you pay for. There's not a lot of thought that goes into ETFs. A lot of times they just mirror an index. But yes, stocks, bonds, bond funds, mutual funds. That's a really fantastic way to get a healthy cash flow into your bank account and feel good about where that money's coming from.
Excellent. Well, as we probably should have our rider on the end of our presentation that seek your legal and investing advice. This is purely for discussion and learning, and it's not direct investment advice for any of us, but it's a great forum to share questions. I hope that we've gotten through most of those that have come through the chat. I know we were kind of concerned on 2 points about, are we able to generate, market rate returns or a percentage of interest that's competitive? Clearly, the answer is yes, from ethical, sustainable, and governance screened, or ESG screened stocks, bonds, and managed funds. Also, the ability to move money from various vehicles in a DAF, if you want to preserve that initial tax treatment. No, you may not take your money out of your DAF, or you will have both a bit of a penalty plus the taxation that you have avoided when you put it in. But many of these other vehicles are purely liquid, obviously, and behave just like other liquid instruments, if they're public equities. Bonds have a tenor on them, and that would restrict them to some point. Any other questions here that we didn't get out of the chat? I think we should move to our group discussion. So I hope those of you who are on are sticking around. We're going to have an open forum where we get to chat with one another, share both our questions about how are we individually seeking to make impact, learn from one another about different steps we've taken. I know I am only focused in one area, which is private new companies, and I think I have so much to learn from all of you. So I look forward to that. I want to thank Tom Bird for coming on early on in the conversation and sharing his specific experiences, and both Kiah and Stephen for working through both their personal impact investing journeys and the work that they do with clients here in the community. So thank you all again for joining us here at the Sustainable Change Alliance. We all look forward to continuing this conversation in person as soon as we move from this event to our networking forum. So thank you again, and thanks for making time for sustainable change.
Thank you all.
Stephen, we're using a separate Zoom link. Is that correct for the